Good morning. You're watching the market right on ET now. And we continue to consolidate and we continue to actually outperform our global peers. FIIs continue to turn buyers. For the last 3 consecutive sessions, you've seen some steady flows coming in despite a strong dollar. So, yep, I don't think there is anything denying D-Street's rally. In fact, over the last 1 month, we've had a good 2% move, Nikunj, as opposed to the Dow, which has just barely done anything, was down about 3/10, or for that matter, other markets like a FTSE, which were down actually 2%.
Okay, we are in a range, we are consolidating, but nothing wrong with it.
Yeah.
We've had patches of few months of consolidation.
And we've outperformed the rest of the globe as well.
You're doing very well for yourself. I think there is no reason why anybody should assume that we've reached the end point of the rally. This market is running out of steam. What is the next trigger? No. I think, say it again, the best part of the summer rally of 2023, I think, is not over. Let me establish that slightly further. Look at the market YTD, which is what's happened to year to date. And you're up about 2%. The small and the mid-cap index during that same time, they are up 7 and 8% respectively. Now that's a very commendable feat for individual, for the broader market, that for this year you are up 7 to 8%. Now, Nifty is almost at a new all-time high. I'm discounting that 2%. The mid-cap index is almost at a new all-time high, but the small-cap index is nowhere close to its all-time high, which means that the froth in the market, the more you go down when it comes to the penny stocks, the HNI dominated stocks, stocks which go up largely because of demand and supply, not because of fundamental factors, stocks which always end up adding, which always rally in the tail end of a market cycle. That market, I think, is nowhere close to the valuation levels or participation levels what we saw in 2021 or early part of 2022. So what makes me confident that the best has not come is because 5 days of consolidation and everybody is saying that, okay, the best of the gains are over. It's not going to happen this way. B, where is the participation? Yeah. C, the small and the mid-cap stocks are not at an all-time high, and they are the ones which always are this, canary in a coal mine. I use this phrase very, loosely to say that the canary is an indicator of what is going to happen in a coal mine. Small and mid-cap stocks are an indicator to what will happen to the market rally. They are not fat, they are not obese, there is no participation.
Yeah, and even if you just look at the construct of what the market has done this year, like Nikunj was saying, the mid-cap index has put on a good 8%. By the way, the mid-cap 100 index is already at a life high. The small-cap index is up 7%, and equation to that, the Nifty is higher by 2.25%. So clearly seems that there could be more legs to the rally. Even if you were to look at the gainers from the March 29th lows, it's ITC, which has surged about 72%. It's M&M, which is up 82% with the stock now at 1400 per share levels. Eicher Motors, Britannia, and yes, there is an IndusInd Bank, but there is no HDFC Bank, there's no Reliance Industries. All those names are yet to participate in the rally.
Yeah, you're right. In a market when the flows are reversing, and when flows are reversing largely because of ETFs and largely because of money moving out of China, you would say that the 3 horsemen, what are the 4 horsemen on the Nifty? You've got Reliance, you've got HDFC Bank, you've got Infosys, and you've got ITC. The 3 horsemen are just not participating. It's only the ITC, it's only the juggernaut movement in ITC which is which is standing out. So it's not going to last because flows are coming at a global level in terms of an asset allocation. Second, if these 3 stocks do not participate, then our market's telling us that the new leg of leadership is starting. Will that new leg of leadership this time be slightly different than what the previous leg would be? The outperformance would be slightly different. That only time will tell. For example, in 2021, when markets came off from the COVID, massacre, Reliance led the rally. No other stocks were participating. It was single-handedly one horseman which was taking the markets higher. So
and
maybe
that do it alone because of the weightage it has on the index.
The weightage it has.
Yeah.
So the markets cannot, these 3 stocks in a strong ETF dominated global reversal market where money is coming from China and to India, these 3 stocks cannot stay disconnected for a long. And that gives me hope, and that gives me a bit of a belief that it's a matter of time that one of the stocks is going to take off the block.
Okay, just also walk you through what the global setup looks like this morning. And largely, you've got the US markets, which wrapped up in the green, and that was led by financial stocks as well, coming in across the board. Lots of results as well coming in at the fag end of the earnings season, but a bit of a flattish close with a mild positive bias for the US markets. For Asia, it is looking a little bit mixed as you've got, primarily most of the markets that have gotten off in the mixed region. You've got the Reserve Bank of Australia that is going to be watching out for commentary coming in from there, and as well as China's May trade data. So that is all as well going to closely be eyed. Oil prices as well, you've got a little bit of an ease coming in this time around. They've eased about 1% or so, and that's largely on the back of the fact that the global economic growth could reduce energy demand, and that could outweigh Saudi Arabia's pledge to cut the output costs. Nikunj, as we were talking about as well, when it comes to the broader market, because where the leadership has been, you have seen a strong outperformance. Stocks that have led within the mid-cap space include the likes of an Aurobindo, CGPA, Paytm as well on a year-to-date basis has gained about 35% as well. So while we are facing resistance around 18,600, are these indications of a breakout as well?
Avansi, what is the big change in terms of the market template? The change, if you frankly ask me, which has changed, which is there between 2022 and 2023 is that interest rates have peaked out, commodity prices surely have peaked out, and flows have reversed. Now, typically when interest rates they go higher, growth stocks they underperform, and growth stocks in 2022 had become obese, and they went through what could be called as a serious adjustment. Now the reverse trade is at play. So commodity consumers have started outperforming. Growth stocks, which is largely internet companies or fintech stocks, they've started making a comeback. Stocks like Paytm and Zomato, they are now finding they are also occupying center stage largely because some of the promoters have realized that look, the way forward to survive in a listed market is that you have to commit to the path of profitability and you have to be extremely conscious of cash flows. So there are a lot of factors which are at play when it comes to some of the some of the laggards and why they really have become the leaders. But for me, the construct of the market is still centered around the following facts. Valuations are not that expensive. Growth has surprised us. Commodity prices are benign, and interest rates has topped out, and flows have reversed from China. When you see a potent combination of that, all these factors in a sense will ensure that in the near term, in the near term, the market outperformance which is here is not only real. I think it's also here to stay. I started the show with this, and I'll say it again. I will thumb the table again and say that the best part of 2023 summer rally is not over.
Okay, on that happy note, let's also get your color on what the global commentary is like and whether we're in good stead there or not. Anisha is here with a summary of all the global commentary coming in overnight. Anisha?
Hi, let me start with the commentary coming in from Lawrence Summers. Now, he says that he's glad to see that the entire debt ceiling worry is behind us. It's in the rear view, but he's quite worried by the balance sheet situation of the US at this point of time. He also says that the deficit on account of this would be much higher than what the country has seen. In fact, he says that it's reasonable assumption that the deficit will exceed 10% of GDP in a few years. This would by far be the worst long-run fiscal outlook in our history, and there could be a question of how long the world's greatest debtor can continue to be the greatest power. So that's a commentary coming in from Lawrence Summers. Meantime, Mohammad Al Arian had to say something about the latest data coming in from the UK. He says that the UK consumer data suggests the growing budgetary pressure that the households are facing. The retail sales are at the slowest pace that they have seen in 7 months. Despite the holidays, food inflation continues to be high, and the higher mortgage payments is also something which is impacting the sentiment in UK. Separately, the comment coming in from Apple CEO Tim Cook during the Developers World Conference, which is underway at this point of time. He said that he personally uses ChatGPT. He's quite excited about the unique applications, and the company too is looking closely as to how they can leverage the ChatGPT and other AI opportunities to make the services and platform better.
Okay, Anisha, we'll leave it at that. That's the word coming in from Tim Cook. But let's move on and let's tell you what the charts have been reading like, considering it was a day of consolidation yesterday as well. Naresh, Kunal, both on the show with us. Gentlemen, hi, morning. Kunal, another day of consolidation, or does it seem like we could move in some sort of direction?
Good morning. So I would believe that we should be heading towards a breakout pretty soon, possibly in the next couple of days, 6-7 days of consolidation for the index. Interestingly, the index or the Nifty chart on the hourly basis is forming a flag pattern, and in a flag pattern we entered into the flag pattern on a bullish note and then went to a consolidation. Typically, we see a breakout post the flag pattern, and that generally would probably happen hopefully happen in the next couple of days. And once that happens, we could be looking at least another 300 to 350 points on the upside for the index. So when we try and look at this from the 18,600, 650 mark, we could be eyeing a breakout potentially above the new high for the index, hopefully in the next few trading sessions. So bullish bias on the index continues. The sector churn is also quite interesting. Yesterday we saw a mix of real estate stocks, the high beta pockets performing quite well for themselves as compared to the traditional private sector banking names, which have been an underperformer. So I think in that regards as well, there's a good mix for the markets where the mid caps are still performing quite well. So the bias remains bullish on the indices and expecting a breakout hopefully in the next couple of days.
Nuresh, let's look at the market from perhaps two ways. One, the Nifty, and then the Bank Nifty. How would you look at Nifty and the Bank Nifty? Because clearly if HDFC Bank and Reliance and these stocks are not moving up, there would be a bit of a challenge.
So, say if you look at Nifty, it has not made a new all-time high. The Bank Nifty has made, and it is much higher. The reason being, if you look at some of the banking names, they've seen a strong move, and the smaller banks have done well. Something like Axis Bank just made a new 52-week high yesterday. You have ICICI Bank, which is 2% away from a similar number. You have IndusInd Bank, which has made a 52-week high. Kotak Mahindra Bank, even though did make a high for a single day, a 52-week high, but has not sustained. But overall, the structure is much better in terms of the constituent weights. But in the Nifty, what happens is you have Reliance, which is quite a bit away from the 52-week highs. There is HDFC Limited, there is Infosys, there is TCS, a bunch of other IT names. So out here, the heavyweights are not closer to 52-week highs and all-time highs. But from the current prices, even one of them moving up could take Nifty towards an all-time high. So overall, very positive. Expecting, say, HDFC Bank to turn from this 1550, 1590 mark and slowly make an up move. Similarly, at 1900, 1940, Kotak Mahindra Bank also looks like a recovery. So expecting either of these two names or say IT names making a bounce back could make a difference. But for now, expecting this large private banks to bounce, and that could create a fresh 52-week high on the Bank Nifty, and maybe we get closer to the all-time high on the Nifty.
Closer to all-time high on the Nifty. I'm going to just change gears and talk about stock ideas now. And Nuresh, what is there on your radar?
So first is a buy on ACC. The stock saw a deep correction, just like the rest of the names post the Adani issue. Now the stock has flattened out. The stock is making a classical, what you call a bottoming formation, which happened with Ambuja Cements out here. Given that the move in Ambuja Cements has gone up all the way to 450, 460 levels, there should be a catch up in ACC. So a range breakout on cards above 1860, 1870 levels. Expecting a move towards 2000, 2100 in the short term, a stop loss at 1820. Second is a buy on Hero MotoCorp, which is a long-term trend change after a period of time. So the stock pre-COVID had a peak around 2800, 2900 for 2019, as well as 2800, 900 was the price for the stock back in 2014 as well. And now finally, after 8-9 years of say underperformance to the banking, to the whole benchmark of Nifty Auto, the stock has started showing a lot of momentum in the last 1.5-2 months. Relative strength has started improving, and now we are setting up for a breakout. And when such a breakout takes place, we would expect a move towards the previous 52-week highs at least, or an all-time high. So medium term view would be it could go towards 3600 to 4000. Short-term breakout target would be 32 3300, stop loss at 2850.
Kunal, what's on your stock list?
The first one is about Grasim. The stock is coming out of a deep underperforming zone. Yesterday, the stock showed signs of a breakout. So would suggest a buy. Targets of 1850, stop loss at 1738. And Oro Pharma is the other stock, which I think is forming a bullish pennant formation on the Ali charts. So I've been bullish on the other pharma names, large cap ones. I believe even the mid cap ones could probably start to perform quite well from a short term basis. Targets of 700 on Oro Pharma, stop loss at 650.
Right, okay. Here's a word then from Jonathan Garner, Asia Equity Strategist in Morgan Stanley. He spoke with us on the sidelines of their conference currently underway, and he has a bullish earnings growth outlook on India. Let's hear out his overall outlook on India markets.
Well, the earnings growth outlook is good. Our colleague Ridham Desai has a convincing case that earnings compound annual growth rate can be around 20% plus. On a 3-year forward basis. And the companies are executing well. The issue is really around valuations. So last October, when Korea, Taiwan and China were so cheap, the Indian market, if you look at, say, Sensex on a forward PE basis, was at very high valuations. And MSCI China, almost 23 times forward PE, a near record valuation premium to Korea or China. Now that gap closed through the Indian market having a relatively poor performance late last year and early this year. So by the time we got to the end of March, we actually upgraded India from an underweight to a neutral, and it's now right at the top of our neutral recommendation, albeit that the valuations are about 1.6 times that of overall emerging markets. That's still above long-run average premium. The Indian market typically enjoys a premium to other emerging markets, but last October it was at a record, and that was too rich.
Welcome back. Let's focus in on stocks that will be in news today. TCS first up in focus after it released its annual report. N. Chandra and the new CEO have highlighted the focus on digital and new technologies like IoT, AI and lots more. Let's bring on board then Anisha, who joins in with all the highlights of that annual report. Anisha?
Hi, let me start with the big comments coming in from N. Chandra about the journey of TCS in the last year and how the future outlook really pans out. He says that the company has managed to perform well in a volatile environment that we saw in the year gone by. The company continues to be quite focused on client transformations and making sure that they remain very nimble to address all the client needs. He also talked about how Indian IT is poised for huge growth opportunity as well, because there's a lot of disruption which is at play in the global market, whether it is in terms of energy transition or the supply chains, and India stands as a focal point for all of these transitions. In fact, he says that there's a huge opportunity when it comes to the supply chain ecosystems as well for India. AI transition, he says, has become a central focus area for a lot of clients, and that's why the company is significantly investing in building the artificial intelligence capabilities. They've already moved away from predictive AI to generative AI, and now they're looking for more applications regarding the same. Similar commentary coming in from the CEO Kriti as well. He says that there's a sustained focus on cloud adoption, data architecture, customer experience as well as business model transformation. They say that the medium term and medium term opportunities will continue to come from 5G, IoT as well as generative AI, and virtual reality as well as metaverse is still something that the clients are talking about, and even digital spends continue to be quite high. The order book stands at around $34 billion, which gives them good medium-term visibility, as well as the pipeline replacement is something he says is quite strong, given that client conversations have been quite positive, at least in the last few months that he's spoken with the clients about. In terms of the big remuneration changes happening, because that is something that is of interest to the viewers as well, the total compensation for Rajesh Gopinathan in the year gone by stood at around 29 crore rupees. For NGS, it stood at around 24 crore rupees. And for the new CEO, Kriti, of course, a very basic salary structure has been provided, but it says that the basic salary could be between 10 lakh to 16 lakh per month. Other perquisites could be to the tune of 55% of basic salary, but the large part of the pay, of course, comes in from commission, which is something which depends on the future profitability of the company. So those are the key highlights coming in. Just a word coming in from Samir Seksaria as well. He said that 1.4% margin impact in FY23 came on account of attrition, and that is hopefully not expected to happen in FY24. So he sees a lot of margin levers as well for the company.
Anisha, we'll leave it at that, and it's Conference season clearly for investors around the country, and brokerages are releasing reports on various companies as well. When it comes to urban consumption, how is Nykaa, how is Indian Hotels poised for growth? Morgan Stanley shares their view, and Vinny is here to summarize the same. Vinny?
So in terms of the highlights that we're getting in from the Morgan Stanley conference on Nykaa as well as Indian Hotels, let's talk about Nykaa first. So what is highlight? The main highlight is coming in that Morgan Stanley said that they're expecting a faster growth in the beauty personal care segment, especially in the gross merchandise value than the e-commerce industry. So that is something that you're watching out for. Overall, the company is planning to add 50 new stores in FY24. Gross margins, they said, in fashion segment could be something that is higher than the BPC segment as well. So that's interesting and one to watch out for as well. While a margin driver included lower market expenses and rising ad incomes as well. So that is a factor you should be keeping an eye out on in terms of the margins of the company. Attrition has been a normal business scenario and churn rates are lower than the industry is what Nykaa is highlighting. Let's move on, talk about Indian Hotels. Now, Indian Hotels, the management seems to be quite positive in terms of the demand side. They remain positive and bullish on the demand side. They're highlighting that the supply growth will remain in the mid-single digits for the next 2 to 3 years, and where the growth is coming in from, where the increase is coming in from, bulk supply is coming in from, is from the tier 2, tier 3 cities. So what is also happening for Indian Hotels is now the banks have actually started funding the banking, the hotel projects as well. So they are getting some funds over there as well, and the company is committed to delivering a 33% margin on a sustainable basis. Supportive macro environment as well as improving connectivity is something that will drive the growth for the company. These are the key highlights that we are getting in from the conference.
Lots of reports have actually come from the Morgan Stanley conference, and you've got Sun Pharma, JSW Steel, State Bank of India, iShares, a lot of reports. They're bullish. I mean, Rhythm's really got it right. He was bullish, he is bullish, and he clearly has indicated that for next 10 years he will remain bullish when it comes to the economy and the earnings growth. But a stock which I want to discuss, and this in a sense has puzzled me, is Bajaj Finance. Why? Why is Bajaj Finance going higher? Expensive. Valuations are stretched. It's an enviable franchise. But for a stock which in a sense saw the maximum FI selling, currently, because of valuations, and valuations have not become attractive, I think has done rather well for itself. That's Bajaj Finance for you yesterday. Bajaj Finance this year has been a ranked outperformer. Naresh, I mean, it was the toast of the town. It got completely chopped last year, and now it's made a roaring comeback.
So what we've seen is everything in the NBFC space has started doing well over the last 1 month. But if you were to look at a little, say, longer time frame, the return for Bajaj Finance for the last 2 years is zero. And even from the pre-COVID prices of 5,000, the stock has gone up to 7,000. Now, this is a stock which used to have a much, what do you call, a relative outperformance to the Nifty, but that has gone off. So for now, we are getting into a tight range wherein the stock goes to 5,500 and takes a pause, goes closer to 7,500, 8,000, takes a pause. So in this move also, I would expect it closer to 7,500 is a top for the near term. Would get a little overstretched around that area. And we've seen even a Paytm has done well. So across the board, financials are doing well. So Bajaj Finance is also catching up, but does not make a lot of sense here to be buying in it. I would expect a top at 7,500 and then again get into a sideways consolidation for months together.
In on Bajaj Finance, of course, yesterday the big sectoral winner was cement all the way. Grasim is one stock that Kunal highlighted, but aside of that also, Kunal, everything from Ambuja, ACC, India Cement, Ultratech, they were all abuzz. Do you think we could see a follow through today?
Well, I think yes, Aisha, because in fact the move actually was led by the likes of Shree Cement, which was one of the better performers in terms of price. Dalmia Bharat did pretty well for itself. Ultratech Cement, if I'm not wrong, made a very, or came close to its all-time high levels of, I think, 8,100 approximately on the spot level. So there was a lot of large cap leadership which came back again yesterday. And of course, the mid-caps also saw a good pickup of price action. Ramco Cement, yet another, made a yet another high for itself. So a lot of the cement stocks are either moving into a new tangent or a breakout for themselves on the large cap front, as well as on the longer term charts, as well as the underperformers, the likes of Shree Cement, Grasim, etc. These stocks are also showing signs of covering up their underperformance. So I believe that when you see both ends of the sector moving up pretty well, the leader stocks or the performing stocks performing and continue to perform well, and the underperformers also trying to pick up pace, that's a strong sign that the sector has gained momentum, and you would probably want to ride on to the momentum. So I would believe that there should be more follow through price action for a lot of these cement stocks.
All right, follow-through price action anticipated when it comes to cement, according to Kunal. But moving right on to fresh brokerage notes, and Morgan Stanley has an overweight stance on banks. The likes of SBI, BOB, IndusInd Bank all feature on its radar. Let's take it across then to Harsh, who joins in with the latest note on what Morgan Stanley has to say. Harsh?
Right. Let me start off first off with State Bank of India, the largest bank in the country, maintaining an overweight Morgan Stanley. 715 is the target price. There you're looking at loan growth, which will be in the 12 to 14% band, largely where even the bank has guided. That's what Morgan Stanley is expecting, aided by retail, SME and mid-corporate. They're expecting margins to remain in a tight range. Mind you, there's still scope for some margin expansion with that MCLR book yet to be repriced. So you'll see some of that play out as well in FY24. And Morgan Stanley expects that as well. You're looking at credit costs, though, which are expected to remain below the normalized level. So that's a positive which will aid SBI in FY24 as per Morgan Stanley. Target price one more time, 715 a share. You're looking at Bank of Baroda as well, which Morgan Stanley has covered. They've maintained an overweight, $240 a share is where they've pegged their target price at around a 30% upside or thereabouts. You're looking at a loan growth there of around 14% for FY24, 1 to 2% higher than where the system growth is expected at. They're expecting to continue to gain market share in that regard. You're looking at margins to remain above the FY23 level, so that's a positive coming in for BOB as per MS. What they're also suggesting is that the product mix may shift towards a higher margin segment. That's a positive. And what they're also expecting is that the ECL provisioning to be around the 1.5% mark. So what you're therefore anticipating is not a very large ECL or a chunky ECL provisioning coming in if the ECL provisioning guidelines do go through, that is. You're also looking at IndusInd Bank, Morgan Stanley keeping a target price of 15.25 a share on that one. They are suggesting that growth will come back, 18 to 23% growth guidance given through the MFI turnaround. That's a positive. Vehicle and affordable finance also will drive growth going forward. They're also suggesting funding costs to go up by 30 to 40 bips and a funding cost to stabilize in the second half of FY24. They've reiterated what the management has suggested to be credit cost guidance of 110 to 130 bips. Morgan Stanley endorsing that guidance.
Harsh, we'll leave it at that. In Bajaj Auto, they also conducted their analyst meet. What's the stance that brokerages are now having on this particular stock, and what were the key takeaways? Vamakshi is here with an update.
Well, yes, analysts at JP Morgan caught up with the management of Bajaj Auto, and here are some of the important takeaways from that meeting. Well, export volume is expected to see a gradual recovery, but the unavailability of forex is still remaining a challenge for the company. Domestic two-wheeler segment is seeing recovery, but an improvement is being witnessed in the over 120cc segment. The company has launched its three-wheeler EV in the Agra market, and in fact, they're targeting to launch one EV every year. Two-wheeler EVs, however, may have a short-term negative impact on the margins, especially mainly due to changes in the subsidy. They're seeing slight inflation in the metals basket. There could also be some cost pressures coming due to the BS6 phase 2 norms. Triumph motorcycles are expected to launch later in June. So given all these positive factors, JP Morgan has actually maintained its overweight call on Bajaj Auto. They've given a target price of 5,150 per share. And given all the positive commentary that came in from the analyst meet, Bajaj Auto is in focus.
All right, thanks very much, Vamakshi, for those details. Let's move right on then and shift gears and take a look at all the stocks that will be seeing price band revision that will take effect starting today. Along with the Adani Group stocks, which are some of the other stocks in the spotlight, Sharad is here to tell us just that. Sharad?
Well, yes, a total of 477 stocks would be in focus where there has been a price band revision, and this will be effective from today onwards, which is June 7. Now, the focus will be there on the Adani group of stocks as the markets are expecting more cheer coming in as Adani Transmission, Adani Green Energy and Adani Wilmar. Their price bands have actually increased from 5% to 10%, and looking at Adani Power, their price band revision has gone up from 5% to 20%. So Adani Group would be in focus. Apart from that, action is expected in the small cap and the mid cap space as well, where from the price band revision of 5 to 10%, stocks such as Jupiter Wagons, Varitech, RMC Switchgear and Gensol Engineering would be in focus. While if you look at the stocks like RVNL, over there itself the price band revision is expected to come from 5% to 20%, so we can expect volatility there. And lastly, from 10% to 20%, the stocks which include in this list are Goa Carbon, Hindustan Foods, Butterfly Gandhimati Appliances, Gland Pharma and Fact.
Right, okay, we'll leave it at that, and let's also get you some fundamental ideas then from Pankaj Pandey, and here's what he has to say about NBFCs.
We have started liking M&M Finance. I think one is, I think they are looking to double their book over the next 2-3 years, looking to expand into newer geographies. So that is one stock which we are liking. The other thing is even L&T Finance. So our expectation is that you'll see good 30% plus growth over the next 2 years. And largely, most of the book is going to be retail. So there is a shift happening from wholesale to sort of retail. So upside there in these NBFCs look a lot more higher. Banks will sort of continue to sort of deliver well in line with the overall credit growth. So credit growth is still holding up 15-16% and no major asset quality concerns. So that way, I think our sense is that banks will sort of keep doing, say, 15-20% kind of a return, but NBFCs can offer more returns because valuation-wise, so even for L&T Finance, I mean, while the ROAs could inch up to 2%, it's available at one-time book.
All right, let's connect with Dipan Mehta, who's joining in, Director Elixir Equities, to get in his take on the markets. And Dipan, what do you make of the fact that despite the fact that we're near all-time highs for the index, a lot of the heavyweights haven't really made their presence felt? Reliance Industries, HDFC Bank, ICICI Bank, from the 1st of December, these stocks have either been down or completely flat.
Yeah, good morning and thank you for having me on your show. This is a mid-cap market actually, and I have no problems with it because actually speaking, portfolios are doing exceedingly well. Sometimes we see optically the index keeps on moving up. It's on the strength of 2 or 3 large index companies, which one may or may not have in their portfolio, that do not at the proportion or weightage which is there in the Sensex and Nifty. But by and large, I think a lot of these side counters are doing exceptionally well. The number of stocks hitting new highs also is moving up. The advanced decline ratios the last few weeks have been also very positive. So I think it's only a matter of time before the Sensex Nifty also start to scale higher and reach new highs. I suspect that a lot of investors' portfolios are anyway trading at new highs. And that's a very positive phenomena and does give more confidence to invest into equities and perhaps commit even a higher exposure from the savings pool.
Where is it that you're confident about when it comes to the mid-cap universe? Because we were mapping out the data, and in terms of what really has led the markets higher include a lot of the mid-cap names, the likes of Polycab, Aurobindo Pharma, Paytm, Persistent Systems. What is your take as to where to deploy funds within mid-caps currently?
See, I think one strategy which has worked very well is that in any sector which you are positive on, if you go down the line, look at the tier 3, tier 4 or tier 3 or tier 2 companies or the mid-cap companies within that particular sector, then you will find that in bullish markets like this, those companies will tend to outperform the market leaders or the large cap companies within that sector. So for example, if you like the NBFC space, then companies like Cholamandalam, MFI companies like Spandana or Credit Access, Poonawalla Finance, I think Awas Finance, these are the companies which will tend to outperform the larger ones, like say a Bajaj Finance or a HDFC for that matter. And similarly, down the line, when you go to banks, I think smaller banks like IDFC First Bank, AU Small Finance Bank, to an extent Federal Bank, and even IndusInd Bank, they may outperform the ICICI Axis and Kotak HDFC banks. And that particular investment theme is true across many sectors. You can play it out. You can see it being played out in software, in pharmaceuticals, as well as in capital goods and engineering companies as well. So I mean, there are many sectors which are in sort of a blue sky scenario, looking at good earning visibility. But within those sectors, if you go for mid-cap stocks, you can have them outperforming the index and the large cap peer group companies.
The Nifty IT performance has been month to date, and in the meantime, of course, you're having a whole host of these analyst meets as well, and TCS's annual report just came by yesterday, wherein N. Chandra as well as the CEO of TCS have highlighted the focus on digital new technologies like AI. Just yesterday you had Infi's annual report as well, wherein the number of times AI was used was actually 56 and number of times artificial intelligence was used was 4. So all in all, that's a heavy duty 60 count, at least from the Infosys annual report takeaways. But Dipan, clearly seems that Indian IT as well is advancing and understanding the need for AI and the need for that progression. But you think these stocks become a good buy now?
See, I think that whether AI is going to provide the same kind of wave as, say, Y2K and internet and digitalization, cloud computing, there were so many waves in the IT industry because of which we saw great wealth creation over the past almost 2.5 decades or so. And whether AI is a similar opportunity, it's a bit early to say so, at least from a non-industry perspective. But yes, I think it's certainly a growth opportunity and it may lead to higher IT spends. But the problem with large cap Indian ITs is the size. And unless they don't get, $200-300 million type of contracts, it doesn't really move the needle that much. So I would be a bit more selective in IT, go for smaller companies. In any case, I think mid-cap companies have really established themselves. They've created their niche. Large Fortune 500 companies also realize the value they bring to the table. And some of the companies which are focused on very specific verticals where there is limited scope or little scope of IT spending cuts, I think that's the ones we should focus on. Disclosure, I mean, companies like Tata Elxsi, KPIT Cummins, Persistent Systems, to an extent even Coforge, I think, they are all focused on very specific verticals where I feel that the risk of slowdown in spending is little less compared to the large BFSI players or those focused on retail or insurance for that matter.
Let's just bring up Nykaa as well after the Morgan Stanley note which has come out post their analyst meet. And you've got Morgan Stanley now maintaining their overweight with a target of 188 on Nykaa. They're saying that they see faster growth in the beauty and personal care segment versus e-commerce, and saying that the company plans to add 50 new stores in FY24. The gross margins in fashion actually could be higher than beauty personal care segment. And the margin drivers from here on, according to them, are going to be lower expenses and rising ad income. Attrition also, they said, was normal in the business scenario, and the churn rates are lower than that of the rest of the industry. And, that's why they're having this overweight call with a target price of 188 on Nykaa. But Dipan, I think out of all the new age tech businesses, Nykaa, I think, has been the slowest to recover perhaps from its 52-week lows or the recent correction which transpired. What's your call on the stock?
See, we have invested in Nykaa at the time of IPO, and clearly we are seeing kind of a correction, and it has certainly not done well for us and many other investors. Maybe it's a mismatch in understanding, over expectation. I don't know the real reasons, but as we are discovering this company more and more, we do feel that that's got far more challenges than before. The competitive intensity certainly has increased, although Nykaa does have certain strong moats to protect its business. But it's not, it's going to be difficult for the management to really scale up as we thought earlier, as well as to come to solid profitability. And I feel that other comparable businesses or other platform companies like, say, Zomato or Paytm have made far greater progress in terms of their road to profitability. And I would even like to consider Policy Bazaar. I think they're also, they are making good progress to come to profitability. But when it comes to Nykaa, because of the business that it is in and because of the competitive intensity, I'm just a bit skeptical. And these companies now, there are so many choices elsewhere in brick and mortar which are available at reasonable valuations. And I feel that there is greater scope of outperformance in those businesses than in Nykaa at this point of time.
All right, there you have it. Interesting there that you hold Nykaa in the portfolio. But let's find out the stocks on the editor's radar. Today we're talking about IndusInd Bank as well as the entire cement space. And cement has really been hogging the limelight off late. It's interesting as well to see the kind of delivery data. And when you map these stocks as well, Nikunj, with respect to the raw material price trend, how are they looking?
It's not a $9 decline, it's like a 15% decline.
Yeah.
It's like you always say in Kotak ad, no, that it's not 2% higher, it's 50% more. Now 14% lower for the most important ingredient, which is the raw material, which is coke, I think is going to have a huge advantage in terms of what the margin expansion for the cement companies would be. 2023 was a terrible, horrible and a tough year for cement companies because demand had slowed down, transportation cost was high and raw material cost was also very high. I think if you are looking for a sector where there could be a meaningful risk to your upside, meaningful risk in terms of getting your estimates wrong, I think it's cement, because I expect that cement companies in this year will come out with strong numbers, A, because of last year's base, and B, given where the demand is moving, and C, the fact that this time around, since we will have this extra element of the entire pre-spend which will start happening because of the election year, that election cycle spending by the government also will be coinciding in FY24. So there are a lot of triggers. I think markets are slightly more negative on the entire sector per se because this sector always has given a volatility in terms of number, largely because of external factors. So the way I look at cement is demand is robust. This sector is capable of giving you an earnings surprise. Go for large cap cement companies rather than mid-tier cement companies. Consolidation in the sector has already started. Adani group of stocks, they managed to cross over that speed breaker, so to speak, which had an impact on their business. So I think that worry in the cement sector, which had come largely because of what was happening to Adani group of stocks also, that's also behind us. So it's got all the ingredients, let me put it this way. I expect the sector to be an outperformer, but within that, avoid small cap cement companies because they don't have pricing power and they do not have the advantage of scale and skill.
Stick to the large caps when it comes to cement. That's the editor's take. But let's discuss IndusInd Bank as well. And it seems, Nikunj, that the restructured assets now have reduced and a lot of factors, the margin stability, etc., seems to be reinforcing that things are getting better.
We don't talk about IndusInd Bank as much as we keep on talking about HDFC Bank's underperformance. A lot of attention goes in discussing HDFC Bank's underperformance and not IndusInd Bank outperformance. Let's look at it. IndusInd Bank at the Morgan Stanley conference has come out and given a certain degree of endorsement that they are now confident of a double-digit growth. Credit offtake will remain strong. There is a trigger that Hindujas are looking at increasing their stake. They've got their house in order. They've post-IL&FS crisis. They've gone through a couple of years of a rather painful adjustment both in terms of their books and also a decrease in terms of their pre-multiple or price to book. Now look at IndusInd Bank. Now we don't realize it. 40% higher. And this one is 16% higher. I'm not comparing HDFC Bank and IndusInd Bank, but all I'm saying is that it's getting unnoticed. Why it's getting unnoticed? Because in market, Avan, what I've learned a couple of years ago, you always have your recent past performance as an indicator of what will happen in the near term. And that is where I think IndusInd Bank is suffering now because the recent bout of underperformance has led to everybody believe that this stock will never make a comeback. And that's the time you really want to be slightly more contrarian. I think in terms of momentum, it has rediscovered momentum. The book quality is getting right, the trigger from Hinduja. And I think it is also trading at valuations which are relatively cheap.
All right, so time to rein in your focus on IndusInd Bank, Aisha. That's an interesting take from the stocks on the editor's radar.
Oh, absolutely. But how did the non-life insurance industry fare in the month of May? Harsh is here with data and he's going to number crunch for us. Harsh?
Well, yes. So within the non-life life insurance basket, we've seen premium growth of around 18% on a year-on-year basis for the month of May. And within that basket as well, private has outperformed the PSU basket and by quite a bit. 21% growth is where private premiums or premiums for private players have grown by versus just 13% for the PSU basket general insurers. So clearly that outperformance being seen. But let's speak about a couple of private players at the moment. We'll speak about ICICI Lombard and Star Health. CLSA has come out with a note. They've suggested that growth in Star Health at 16% versus the 12% last May and versus the strong 25% growth in April looks slightly softer. And what they're suggesting is, of course, that the product which Star Health markets the most, which is the Family Optima product, that has seen the renewals have seen a shift in pricing from the 1st of May, and that's probably the impact spiraling in on that premium growth number. What they're also suggesting is that we have to, of course, wait and watch more details, but that's where the drag on the premiums is coming for Star Health. On the ICICI Lombard side, they believe that the growth momentum remains strong for ICICI Lombard. It clocked a growth of 17% in the month of April, now clocking a growth of 20+% in the month of May. And health insurance grew 40% in April at 23%, especially the retail health side grew 23% in May. So what you are seeing is a strong shift towards retail. Motor was largely flat for Lombard, and that's been the strategy for Lombard. So nothing new, but the growth continues to remain solid for Lombard. Star Health slightly on the softer side.
Thanks very much for giving us those details. That's the view coming in on some of those health insurers. But curious, Dipan, to get in your take, and if we were to discuss IndusInd Bank and talk about the triggers that and the kind of commentary that the bank management as well has given, why do you believe maybe that its outperformance recently has gone unnoticed?
So I think some of the sheen of IndusInd Bank certainly has got wiped out, the way they handled the post-ILFS crisis and the way the NPAs moved up. And after having studied the company for more than a decade, I've come to realize that the company has got a lot of exposure. The bank has got exposure to some of the riskier, I would say, segments in the banking industry. They have a large MFI portfolio. They lend to the vehicle financing as well. And there's the jewelry lending business to the diamond industry. Now, all these businesses tend to do well when the entire economy, the sector is doing well. But when things go sour, that's when the NPAs try to climb up in these three particular segments. So in a way, IndusInd is a kind of a slightly more higher risk, high return profile. And right now, I think banks are going through a kind of a blue sky scenario, which is why I think IndusInd Bank's next 2-3 quarters will be exceptionally good. Their credit costs will remain low. And the demand is good from the segments to which they're lending to. I think also there's a scope for a marginal improvement in the price to earning, price to book ratio as well. It's trading at a steep discount to some of the larger peer group bank companies. So keeping all of that in mind, I think we could have a medium term or a short term trading rally in IndusInd Bank. But this is not the company you want to hold for many, many years, especially when the banking industry is going through a down cycle. It cannot be part of your core holdings like, say, HDFC Bank or ICICI Bank or Axis for that matter. And you need to have a little bit more, watchful eye on how the NPAs are moving up quarter after quarter.
I'm just scanning through the insurance sector, and the growth for the general insurance industry is actually not bad. 16%, 18% year on year. LIC is losing market share. ICICI Lombard is gaining market share. Star Health is gaining market share. Dipan, COVID has taught us the importance of safety. You buy term insurance because you want to protect your near and dear ones. You want to buy health insurance because you want to you want to ensure that if there are some medical needs, they are taken care of. Now, that's a long-term, multi-year trend, and COVID has only accelerated the adoption of this trend. Yet, if I look at insurance stocks, I mean, they have been the biggest underperformers in everyone's portfolio. I mean, like your eyes are popping out right now, Dipan, my eyes also pop out when I look at the underperformance in insurance.
Yeah, Nikunj, good morning. But it's, I think, partly to do with what happened in the last budget as well. And slowly and steadily, I think the regulator and the government feels that the kind of a tax arbitrage or the interest portion arbitrage between mutual fund banks and insurance should try and get bridged. So from that point of view, insurance products will get slightly unattractive. But you're right. I think the runway for growth is phenomenal for these companies. And if they get the formula right, if they have got good tie-ups, if they've got a good marketing strategy in place, if they've adopted technology, then I think these companies can scale up reasonably well. One should always keep in mind that a business like insurance is a great secular business. I think year after year after year, you will keep on getting that enterprise value moving up by, for the private sector companies, in that 15 to 25% range. Something like LIC, I'm pretty confident they can do a low double-digit type of improvement in their enterprise value. And I think that should keep investors interested. I wouldn't want to be completely out of the insurance sector or be terribly underweight as well, because this sector does tend to come around quite quickly, especially when the markets go through a bearish phase. And you're right. I think the non life insurance business that should scale up well. The likes of ICICI Lombard or Star Insurance. I think after a few quarters of tepid performance, I would expect that with the economy moving up and COVID out of the way, number of new vehicle sales also increasing significantly, I would say that the next prospects for the non-life, the general insurance companies, next 2-3 quarters looks quite interesting.
What are you doing at 6 p.m. today?
Sorry, I didn't get the
What
question.
What are your day plans at 6 p.m. today? What are you planning to do? What is there in your calendar?
Well, I think no real plans, Nikunj. We could catch up for a drink.
No. Well, you should watch ET Now. And the reason why you should watch ET Now is because Satyan Gajwani is going to be in conversation with Sam Altman. And he's the man of the moment. He's considered, do you want to understand anything about rebooting and how AI revolution would actually change the world? Well, that's the man and that's the guy you really want to hear. So Dipen, I think the drink will have to wait. Now I've told you what is coming at 6 p.m. on ET Now today.
Forward to it. I think it's a very interesting conversation. And I'm also every day reading more and more about this chat GPT and artificial intelligence. And certainly we want to try and use in our day-to-day lives.
Nikunj, have all your latest emails been written by ChatGPT, or is it you
I've
personally?
Tried it, I've tried it, Aman, and I'm trying to learn right now. And this is something which I really want to implement going forward. It is pure efficiency and productivity, Aman. Instead of writing 3 emails a day, imagine if I'm able to, communicate with 5 emails, or if I'm just sending 2 emails a day, ChatGPT, can it really make it, can it increase to my productivity and can it save time? The answer to that is absolutely yes. I mean, you have to understand technology, you have to adopt technology. If you don't do it, then trust me, your competitive advantage in today's tech-dominated world, I think is only going to, nullify. And, I happen to read a very nice, I happened to see interaction of N. Chandra on one of the media networks, and he said something very brilliant. He says that in today's disruptive world, you really have to be ready to what's going to hit you next. And he says that if you do not adapt technology, the technology adaptation will ensure that your job is not going to be there. I mean, that is something which is absolutely clear and absolutely real. So Dipen, I'm just, trying to put a very big picture argument here. In India, how can an Indian investor participate in this entire AI gold rush? Globally, there is NVIDIA. That's almost become a $1 trillion company. But in India, for those who are watching the show, they are convinced that ChatGPT and AI is the future. And what is the future? Well, that's and as a stock market investor, you need to invest in the future. How can an Indian investor invest in India and maximize on this entire AI adaptation?
So I think if you take a slightly longer term view, a good bet, of course, is the Indian IT industry. Right now, we do not know what proportion of revenues of these Indian IT companies is coming from AI and similar products. But, there was a time a few years ago that Indian IT companies started reporting their proportion of the revenues from the digital business. I do feel that over the next 2-3 quarters, maybe 1 year, the Indian IT industries or the IT companies will start reporting the proportion of revenues they are getting from projects from AI and related technologies. And that will give you instant comparison between which are the companies which are getting a higher and higher proportion of their revenues from AI and similar products and projects. And I think that will give you an idea or inkling as to who the winners are going to be in this space. So maybe a bit early right now to figure out how to play this particular investment theme or who are going to be the real beneficiaries. But I'm pretty sure 2-3 quarters down the line, we will have some idea as to how this entire AI magic is working on Indian IT companies. But I do feel that a lot of the opportunity will get captured by mid-cap IT companies as well. I'm really positive over there. I know valuations are on the higher side, but there's a new energy in a lot of these mid-cap IT companies. And look at the way some of them are hitting new highs, companies like Cient. I mean, we hadn't, it was underperforming for such a long time, and now it's catching up the way it has. So these are highly entrepreneurial driven companies, and smaller projects, smaller acquisitions also can make a big difference to their top line, bottom line.
Nuresh, you there?
Yes, sir.
Any thoughts on how can one maximize in India sitting on this AI revolution?
So the point is, by not participating is the best way you can do it. So for example, I was just looking at data. Nvidia now trades at what, 28x, 30x sales. This is what happened with Tesla, and then it saw a 50% drawdown. So say in 2021, everyone was getting into tech, crypto, etc. And then we saw the biggest correction in that sector. We do not have direct plays. Even the direct plays listed in the US are quoting at astronomical valuations. So what we've seen is whenever there is a huge rush towards such companies, and they've already moved up quite a bit. So Nvidia is up 3x from the bottom, I think. So out here, we don't have this. If one wants to play, all we know is that our IT companies end up being providers for any innovation in one way or the other. And if you look at it right now, you can look at so many small caps and mid cap IT companies hitting all-time highs. We've seen a Datamatics go up 5x from pre-COVID till now. The stock is still doing well. So out there, you can go across the board, and that is where the surprising part is. We did not be looking at the direct plays, but indirect plays in India could be looking at mid-cap, small-cap IT going forward.
Seconds to go for the pre-open session, and well, at ET Now we are in a sense just seeding a thought that ET Now is all about rising with India. If India will rise, it has to be, if India will rise, earnings will pick up. If earnings will rise, stock markets will rise. So it's a matter of time that perhaps Sensex will hit 1 lakh. And mathematically, if you look at Sensex hitting 1 lakh, it should happen in 4 to 5 years. Why it should happen in 4 to 5 years? Because if the normal and the historical rate of compounding continues for equity as an asset class, given that we are in for double-digit earnings growth for next 3 to 5 years, it's a matter of 3, 4, 5 years that Sensex will hit 1 lakh. And the ring of 1 lakh on the Sensex is such a nice ring. So, Dipan Mehta, how soon do you think, when do you think we will hear that ring of 1 lakh on the Sensex? 3 years, 4 years, or 5 years?
Well, I would bet on 3 years, Nikunj, or even earlier for that matter. I think the way this entire
Bullish
rally
person.
is shaping up.
You're the most bullish guy. Everybody have asked this question. They've said 4 years, 5 years, and 6 years. 3 years. Well, you're making somebody's morning really bright and chirpy by saying 3 years, Dipan. Okay, why 3 years?
See, I think, markets and index don't move in a linear fashion. And every time a bull market starts, it does get exaggerated on the upside, and same is true with bear markets as well. I think the way earnings are shaping up, the way Indian economy is shaping up, I think on all parameters, we are making great progress. The FII flows certainly have turned positive, and I expect them to be even more and more on the positive side as we see this build-up of a risk-on trade. The global threats, be it geopolitical or be it inflation, interest rates, I think all of those have subsided. And we are entering into a nice zone when it comes to global financial markets. And I think whenever global financial markets are in reasonably good health, India does tend to get a higher proportion of inflows, and that certainly will drive stock prices higher over here. That coupled with a very solid, I think, earnings momentum for next 2-3 years, a lot of domestic liquidity also coming in, and with election year coming in, you can expect a great deal of government spending also to pick up. So I'm seeing that a lot of the kind of ingredients for a great rally over the next year and a half or so are in place. And it's not unlikely or unexpectable or beyond the scope of possibility that you could easily have a 25-30% compounding return in the Sensex for the next 2-3 years or so. It's happened in the past and certainly possible going ahead as well. But I think more than Sensex at 1 lakh, you will see a fantastic rally in mid-cap stocks. And this is a great time for investors to have a nice portfolio which can create a lot of wealth for themselves.
Fun, good to have you on board. Thanks much for joining in and sharing with us your outlook on the markets. And of course, answering that golden question. All right, the pre-open rates, actually 18,700 is the print that you're seeing on the screen, with the Sensex up at 62,860 levels. What are the mid-cap strategies that our chartists are advocating? Kunal, what's your top bet?
So that'll be a buy on PB Fintech, Policy Bazaar. That stock has made a very good comeback yesterday. So I think after 4 or 5 days of consolidation, the stock formed a base at 585, 590 mark. There were multiple supports for the stock, trying to test those support point, and then from there it managed to see a good bounce back. So would be bullish on Policy Bazaar, targets of 666. Stop loss could be kept at 588.
All right, there you have it. It's PB Fintech that Kunal is looking at closely. What about you, Naresh? Top mid-cap call, given that we're talking about how the broader markets are really driving the move?
So looking at JSW Energy, the stock is on verge of a triangle breakout. The stock has gone through almost 12 to 18 months of sideways correction, down from a top of 400 all the way down to 260 levels. Consolidating for the last 3 months, a classical triangle formation in the making. We've seen power stocks make a trend change. We've seen a Torrent Power hit a new all-time high. So this as a sector looks interesting. Tata Power also has been trying to make some moves. So JSW Energy above 270 would be a quick move. So preempting that breakout, a stop loss at 250 and a target price of 300 for the short term.
All right, thanks very much. Those are the top mid-cap trading strategies. Let's move on then, and here are some of the other top stories that we're tracking. US venture capital giant Sequoia Capital will be splitting their Chinese and Indian and Southeast Asian businesses into 2 independent firms amid efforts to navigate the economic and geopolitical challenge. That split will occur by the 31st of March 2024, and the firm's US and European venture business will continue to be known as Sequoia Capital. Meantime, social media platform Reddit has joined the bandwagon of companies laying off employees. The company has announced it will be slashing 5% of their total workforce, or 90 employees. Remember, tech firms across the US have been slashing jobs after aggressive hiring trends were seen during the pandemic. Mumbai, meantime, is expected to witness strong winds and high waves along the coast, and scattered rains are expected all over Maharashtra over the next few days. Mumbai and Pune are likely to receive some intense rainfall from the 8th to the 10th of June, and the IMD has issued a cautionary advisory for fishermen, urging them to avoid venturing into the deep Arabian Sea for the next 5 days due to the expectations of a cyclonic storm. Meantime, the PGA Tour has agreed to merge with Saudi-backed rival Live Golf. In fact, Saudi Arabia has in effect taken control of top-level golf after the shock announcement of this multi-billion-dollar investment. The infusion could amount to $3 billion, which underscores how Saudi Arabia has muscled into global sports via the use of their oil-funded state finances. And Carlos Alcaraz, who is the world #1 tennis player, will face 22 Grand Slam champion Novak Djokovic in a blockbuster French Open semi-final that's going to take place on Friday. This after Alcaraz has beat Tsitsipas by winning 3 sets in a row in the quarter-final. And to cricket, Team India will be taking on Australia in the World Test Championship final at the Oval Stadium in London today. Team India has lined up one of the best batting units in the world, with skipper Rohit Sharma, upcoming star Shubman Gill, and arguably the greatest batsman Virat Kohli, along with Mr. Dependable Chiteshwar Pujara as the top four. "9:05, it's time for Khabar on D Street, and today it is news that you don't want to miss. We've got a big exclusive as we're understanding from reliable sources that early plans for a succession at Bajaj Finance have already begun. What exactly are the details? Let's take it across to my colleague Ajay Sharma, who joins in with all that news and updates. And Ajay, start off by taking us through what kind of a transaction we're talking about here, a transition, that we're talking about here at Bajaj Finance.
Well, that's correct. This is a very big exclusive we have for our viewers, and this is a very important one. We know what Rajiv Jain actually means for Bajaj Finance and what institution he has built over the years, almost 16 years which he has spent at Bajaj Finance. We understand from very reliable sources that there is some amount of succession plan which has already started at Bajaj Finance. Rajiv Jain will gradually, and I must emphasize on the word very gradually, be elevated at a group level position at Bajaj Finserv. We understand that talks within the management have happened, and hence very early preparations of this plan have also started. So this is an evolution of a role and not a complete departure from his current role. We also understand that in order to make it completely shock proof, this is such an institution we are talking about, Bajaj Finance, they would not want shareholders to feel any kind of a shock if there is any change in management or evolution of the leadership. So they want to keep it very smooth and gradual, and that is why they've started it so early. Let me be very clear that the current term of Mr. Jain actually gets over in March, April of 2025. So we are talking about the 2-year buffer we already have there. And that is why such a responsible management, they have started preparations early. So what exactly is likely to happen? In fact, there are 2 deputy CEOs also at the company. They've been inducted as executive directors now. Additional responsibility is being given. And we understand from our sources that one of the 2 in the next 2 years will actually become the main guy at the helm. And Mr. Jain would gradually evolve, take up much larger role at the group level. In fact, we spoke to the management and they did not give us any clear comment on this story, but we understand this is happening and market has also been talking about it. In fact, to the extent that some of the so many important conferences which are happening right now of influential brokerages, Jefferies, Morgan Stanley, Singapore conference, this issue has come up again and again, and Mr. Jain has clarified that he still has age on his side. He's just 53. He's not going away in a hurry, and if his role evolves with time, let me quote exactly, if the role expands, he would still remain responsible for Bajaj Finance. That's the exact quote which Jefferies talks about. But we understand that multiple platforms, this message has been sent out by the management that there is not going to be any shock. Everything will be very gradual, and they will take their own time to prepare the next set. And these 2 gentlemen, which I'm talking about, the deputy CEOs, have already been given in responsibility of additional executive director responsibilities. So it will be a very phased manner, but at least the winds of change have started blowing at the helm at Bajaj Finance. That's what we are gathering.
That's the big ET Now exclusive. Thank you so much, Ajay, for giving us those details. A succession plan has started for Rajiv Jain in early stages. That's what our sources are telling us. Well, let's move right on then. Today on the editor's radar, we spoke about cement stocks. They've certainly been hot in trade. What is Nikunj's take? Listen in.
It's not a $9 decline, it's like a 15% decline. Yeah. It's like you always say in Kotak ad, that it's not 2% higher, it's 50% more. Now 14% lower for the most important ingredient, which is the raw material, which is coke, I think is going to have a huge advantage in terms of what the margin expansion for the cement companies would be. 2023 was a terrible, horrible and a tough year for cement companies because demand had slowed down, transportation cost was high and raw material cost was also very high. I think if you are looking for a sector where there could be a meaningful risk to your upside, meaningful risk in terms of getting your estimates wrong, I think it's cement, because I expect that cement companies in this year will come out with strong numbers, A, because of last year's base, and B, given where the demand is moving, and C, the fact that this time around, since we will have this extra element of the entire pre-spend which will start happening because of the election year, that election cycle spending by the government also will be coinciding in FY24. So there are a lot of triggers. I think markets are slightly more negative on the entire sector per se because this sector always has given a volatility in terms of number largely because of external factors. So the way I look at cement is demand is robust. This sector is capable of giving you an earnings surprise. Go for large cap cement companies rather than mid-tier cement companies. Consolidation in the sector has already started. Adani group of stocks, they've managed to cross over that speed breaker, so to speak, which had an impact on their business. So I think that worry in the cement sector, which had come largely because of what was happening to Adani group of stocks also, that's also behind us. So it's got all the ingredients, let me put it this way. I expect the sector to be an outperformer, but within that, avoid small cap cement companies because they don't have pricing power and they do not have the advantage of scale and skill.
Okay, let's tell you what the index call is this morning, and clearly it's a bullish sentiment coming in from most of our chartists, but it's pretty much a consensus call on this one, at least for the Nifty. Kunal, Naresh as well as Kush are all calling it a hold. So the moodometer is pretty much right there with a consensus hold this morning. Similar is the call coming in for the Nifty Bank as well. A hold coming in from all three of our experts, Kush, Naresh and Kunal as well, indicating on the market moodometer a hold for the Nifty Bank. Okay, we're keeping our eyes on that 18,700 mark on the Nifty spot. At least we've made it to that level on the Nifty, on the pre-open rates at least. And if we do manage to surpass that 18,700 print on market open, this is going to be for the first time since December 5th of last year, that's 2022. In any case, optically, we're almost there any which way. So it's just a matter of time. 40 points push and we should make it to that mark in any case. But Kunal, what's going to be the leader here? We were looking at the year-to-date movers and ITC amongst the large caps and amongst the key heavyweights was the one which was right on top there. But when would TCS, Infosys, Reliance, HDFC Bank, when would they start contributing to the market move?
Very difficult to say when, but then I think for, as far as I can sense on the charts, the worst for the IT stocks is actually behind because, whether you try and compare this with the Nasdaq or when you try and compare with the mid-cap IT performance, these stocks have moved up, a notch higher from where they were, 4-5 months back. So I think it could just be a matter of time that the large-cap IT names could start firing up. But I would believe that possibly in the next 1 or 2 months, we could see a lot of large-cap names, these beleaguered stocks making a very strong comeback.